I'm Daniel, and this is Group 17's presentation. Now, to give you guys a brief overview of what's going to happen, firstly, I'm going to introduce derivatives and the airline industry. From here, Lena will then talk us through the use of derivatives for jet fuel hedging. After this, Robin will explain to us the use of derivatives in terms of currency risk. Following this, Winter will then go through the use of derivatives for interest rates. Now, finally, Ken will summarize our presentation before leading us into a Q&A session. So what are derivatives? Before we go into details, we first need to explain what derivatives are. It's a financial contract between two parties whose value is dependent on the price of an underlying security. Now, this underlying security could be stocks, bonds, or even foreign currency. Derivatives mainly exist in four forms. These are forwards, futures, options, and swaps. Now, in terms of the airline industry, it has a global market size of over 800 billion, with an expected CAGR growth of 3.1%. This means that the airline industry is exposed to many sorts of risk. These come in the form of interest rates, currency, credit, fuel risk, and so on. Now, the goal of every business is to mitigate this risk, and this is done through the use of derivatives, something that Lena will now go into further detail.
Thanks, Daniel. Fuel costs typically represent a third of an airline's total annual expenditure, making it central to its financial performance, meaning that jet fuel price fluctuations can greatly impact their operating costs. And as jet fuels are primarily derived from crude oil, airlines face a financial risk exposure to crude oil price volatility. An increase in crude oil prices has a cascading negative impact on airlines. Prices charged to passengers could potentially increase, resulting in a decrease of flights if hedging instruments are not in place. To hedge against this risk, derivatives such as commodity futures or forwards can be used. Both contracts are contractual agreements between two parties to buy or sell a specified amount of an asset at a specified date in the future at a price agreed upon today. However, forwards provide flexibility in contract specifications, allowing airlines to customize the terms based on their specific needs, which are traded in the over-the-counter markets, whereas future contracts are standardized and are traded in exchange-traded markets, including daily settlement and rarely involve physical delivery. By entering into fuel price derivatives, airlines can manage the exposure to fuel price fluctuations by securing a predetermined price for future fuel purchases and mitigating price risk. Airlines like Emirates hedge the crude oil element of jet fuel by entering into net cash settled crude oil forward contracts. This way, Emirates can protect themselves from a potential price increase. However, the outbreak of the COVID-19 pandemic resulted in weaker travel demand due to predictive measures, meaning lower attractiveness for flights. Hence, airlines such as Emirates no longer expected to consume the initially forecasted volume of jet fuel. Furthermore, due to the decrease in the market price of crude oil, the fair value of jet fuel also decreased. As a result, this caused a hedge effectiveness charge of 1,098 million dirhams, which was recognized in Emirates' consolidated income statement as the forward contracts failed to mitigate the price risk of jet fuel, and the mismatch of jet fuel volume led to an incomplete reduction in risk exposure. Unplanned financial losses can impact the airline's cash flow and overall financial stability, hurting the profitability and potentially hindering the ability to navigate challenging market conditions effectively, such as the pandemic. We can also see that consequently, Emirates stopped using fuel derivatives post-pandemic. I'll now pass on to Robin.
One main financial risk that Emirates faces is currency exchange rate risk. Emirates currently flies to 85 countries around the world, and as such, would receive revenue in many different currencies. Emirates also procures assets and funds OPEX using different currencies. As Emirates is based in the UAE, all of their financial statements are converted back into AED, which presents a risk as earnings can fluctuate as they are repatriated back into AED. Firstly, looking at revenue, Emirates receives transport revenue from a variety of different currencies across the world, including the US dollar, the euro, the Indian rupee, and the Chinese yuan. As such, exchange rate volatility will impact the apparent revenue that Emirates will receive. Now, looking at expenses, Emirates states that 96% of its expenses are denominated in USD or pegged to the USD, making it the main exposure. However, it's important to note that the AED is also pegged to the USD at a rate of around 1 USD is around 3.75 AED. So it doesn't face exchange rate risk for its leading revenue stream. Rather, it will face exchange rate risk for the other currencies it deals with. To minimize the currency exchange rate risk, Emirates uses a variety of currency forward and currency swap contracts. Currency forwards are financial contracts that allow two parties to exchange a specific amount of one currency for another at a predetermined exchange rate on a future date. Emirates enters into currency forward contracts to lock in exchange rates for future transactions. For example, if Emirates knows it will need to convert a certain amount of USD into AED in the future, it can enter into currency forward contracts to buy euros at a predetermined exchange rate. Currency swaps are also agreements between two parties to exchange fixed and floating interest rate payments, as well as principal payments in different currencies. Emirates could use currency swaps to manage its foreign exchange risk by converting a portion of its debt denominated in one currency to another currency, effectively hedging its exposure to exchange rate fluctuations. Now, looking at profitability of currency forwards, we see that 9-year currency forwards are recognized as current assets in the balance sheet in 2019 and 2020. However, looking at 2021, the currency forwards for the next 10 years are placed as a current liability, including or indicating that Emirates would incur a loss if they liquidated currently. Across financial year 2021, the AED depreciated against the euro and the Chinese yuan, two of its major currencies it deals with. If Emirates used currency forwards to lock in an exchange rate, they may not be able to enjoy the gain from depreciation of their currency, the AED, thus leading to a negative value of their currency forwards. However, we're not certain about the exact forward contracts that Emirates has locked into or the currencies it deals with, and thus this is more speculation by looking at the result and looking at exchange rates. So now I'll pass you on to Winton to talk about interest rate risk.
Thanks, Robin. I'll now go through the third common type of derivatives used by airlines, which is interest rate derivatives. But firstly, I'll touch on some specifics about the industry. The airline industry has always been characterized by low profit margins. It is also an incredibly capital-heavy industry. This means that debt is commonly used to finance aircraft purchases, infrastructure development, and working capital needs. To add to this, the COVID crisis hammered the industry, shutting off international travel for a period, with air travel not coming back to base levels until recently. This meant many airlines had to increase their gearing further. Emirates, for example, took out $17.5 billion in order to survive the pandemic. This left them with a net debt of $92 billion. However, they have since paid this figure down to $44 billion as of financial year 2023. So how does this debt pose a risk? Well, put simply, if interest rates were to rise, the interest-bearing debt would become increasingly costly for the airline and could result in liquidity risk, where the company does not have enough cash to meet its financial obligations. The risk can be reduced through various interest rate derivatives. Some common derivatives used to hedge interest rate risk are FRAs, vanilla swaps, caps and floors, or knockout swaps. For a firm of significant size and debt, e.g. an airline, the most commonly used instrument will be a vanilla interest rate swap. So how does a swap work? A vanilla interest rate swap is a derivative contract where two parties agree to exchange cash flows based on different interest rate benchmarks. One party, known as the fixed rate payer, agrees to pay periodic payments at a predetermined fixed interest rate. The other party, called the floating rate payer, agrees to make payments based on a reference interest rate, typically the short-term LIBOR or SOFR. Airlines are looking to reduce their liquidity risk, so it is extremely common for them to engage in swaps as the fixed rate payer. So how has Emirates, our case study, minimized their liquidity risk? They target a balanced debt portfolio and use prudent hedging strategies, mainly involving swaps. As of the recent financial year, 48% of their debt was on a fixed interest rate basis, with the remaining 52% being on floating interest rates. During the pandemic, central banks lowered interest rates in order to stimulate the economy, support liquidity, and prevent a credit crunch. This meant that swaps that airlines entered into would have had reduced effectiveness and would have actually reduced the profitability of the airline. This is because the fixed rates were locked in before the global rates were lowered, and so the airlines would have had to pay more interest than if they had not entered into the swaps and had paid on a floating basis instead. Emirates, for example, lost $561 million in fair value from the interest rate swaps in 2020. However, since the pandemic, interest rates have been rapidly hiked to combat inflation, which is the exact situation that airlines use swaps to protect themselves against. Despite interest rates rising rapidly, Emirates only saw a 0.8% rise in their effective interest rates over the most recent financial year due to the hedging. The fair value of their interest rate swaps has increased by 709 million over the past 2 years. On top of this, 4.5 billion in loans were refinanced during 2021 and 2022 at favourable rates.
Thanks for that, Winton. To summarise our presentation, operating in the international airline industry inherently exposes Emirates to several common forms of financial risk which we've explored today. Our examples covered commodity price risk for fuel, which is hedged using future and forward contracts, exchange rate risk, which is hedged through currency forwards and currency swaps, and interest rate risk, which is hedged through the use of vanilla interest rate swaps. These are conventional strategies for businesses to hedge their financial risks, which pay off when worst case scenarios occur, because they limit the losses that businesses, in this case Emirates, might make. However, the nature of COVID-19 was so extraordinary that these circumstances led to negative impacts on Emirates' balance sheet. Fuel prices reached the lowest they had since before the global financial crisis, which would usually benefit Emirates, but given restrictions on international travel, Emirates didn't have any opportunities to capitalise on this. Interest rates were low in many countries to encourage consumption and stimulate the economy, but because Emirates had fixed a lot of interest rates on borrowing and were expecting interest rates to rise, this also saw a negative impact on their balance sheet. Low interest rates also saw low exchange rates, which again, possibly would have benefited Emirates depending on the side of transactions they were on, but because of decreased operation and decreased operational spending, there were no benefits that could be realised. These were effects early on in the pandemic, but as we're seeing interest rates start to rise again and fuel prices increasing, these derivatives now have positive balances for Emirates, representing financial gains. That is the bulk of our presentation. We now move on to a brief Q&A session. So Daniel, could you tell me about some other derivatives that Emirates might consider using?
Yep, so in our presentation, we covered fuel price, exchange rate, and interest rate derivatives. However, there are many more out there. There are many other risks such as freight and cargo risk for those that engage in cargo transportation, equity risk, or even weather risk. This introduces other types of derivatives that we haven't mentioned, such as weather derivatives that are based on specific weather parameters, freight derivatives, and equity derivatives. Now, Lena, looking at your section, would it have been beneficial if Emirates didn't use jet fuel hedging entering into the pandemic?
Thanks, Daniel. It would have been beneficial as there would not be a hedging ineffectiveness charge, but Emirates, like any other airline, could have faced significant challenges during the pandemic if they did not engage in jet fuel hedging. However, the incomplete risk reduction shows that hedging may not always be favorable. Therefore, continuous evaluation and refinement of hedging strategies are essential to adapt to changing market dynamics and improve future outcomes. I was wondering, does interest rate hedging completely eliminate liquidity risk for Emirates?
No, and this is for two reasons. Firstly, Emirates does not attempt to eliminate all floating rate interest from their debt. In the most recent financial year, the interest rate swaps meant that 48% of their debt was on a fixed rate basis, meaning that 52% remained on floating rates. Furthermore, with swaps being an over-the-counter derivative, there is always counterparty risk. However, assuming Emirates enters swaps with reputable financial institutions, this risk is considered almost negligible. Now, Ken, what has been the impact on Emirates emerging from the pandemic?
From COVID, we've seen lagged effects of high exchange rates on oil and jet fuel prices. As well as this, we've seen high interest rates being used to tackle inflation as an effect of COVID. So what we see as a result, because these are conditions where hedging are effective, is that future and forward contracts, as well as interest rate swaps, have positive balances in Emirates' balance sheet, reflecting gains for Emirates. So Robin, when might Emirates or other airlines consider currency hedging?
It's a great question, Ken. So Emirates might consider not currency hedging under two scenarios. Firstly, if Emirates deals with a large range of currencies that all have like a net covariance of 0. In that scenario, there'd be a diversification benefit, as when one currency disbenefits Emirates, another currency might also independently benefit Emirates. So overall, their net exposure would be almost 0. Secondly, if Emirates choose to revenue/expense match, so if Emirates receives a large amount of its revenue in US dollars, it might also choose to spend in US dollar products, which lessens its net exposure to a certain currency. So those are two scenarios. All right, thanks for listening to our Q&A, guys.